Mark Lackey is Executive VP at CHF Capital Markets, and he rotates through his subjects. So eventually oil had to come up, and Mark is here talking oil today.
Well, you know, Pat, and I must admit, I got more calls in the last month on oil than almost every other commodity combined. I mean, everybody knows I was in the oil business for 10 years. They're interested in my view, and you know, like everyone else, I have a view. Where the bottom is in the short run is hard to say. I kind of think we could get to 40 in the next month to 6 weeks.
Oh, you've changed your tune.
Well, yeah. No,
6 weeks ago, you were saying when it was in the 80s, you said, oh, no, I'm not going to see the 60s.
No, I agree, Pat. Look, I will concede that, well, I don't know how many people called this kind of price. I would suggest very few. I mean, I know you were somewhat more bearish than me, and I give you credit for that.
I didn't say this price. I'll grant you that. No.
But I think at the end of the day, Pat, there's a lot of reasons why. I've seen this before. This is the 6th worst sell-off we've seen in oil prices in the last, say, since 1986. If you remember 86 and 98, those sell-offs were worse, and they were during a time period of very good economic growth. So those are ones you should compare against.
And give me the numbers that oil went down to. Well,
in fact, we went from 40 down to $7 in 86.
Right, and 98 down
in 98, we went all the way down to $10, and we were in the 40s as well.
Yeah.
So we had some, people should realize those situations were worse than now. Now, if we got down into the 20s this time, which I think is highly unlikely, but I won't say anything can happen.
Yeah, never say never.
I never say never. And so that would put us in line with what we saw in the past. But one thing investors should remember, of the 5 big sell-offs in the last 30 years, what happened within the next 2 years? You made more money in oil stocks, about 16 to 20% more than you did in the general market. So we did see a recovery, Pat. I'm not saying we got all the way back up to the peak. We didn't. But in those other 2 years, we did get back into the 20s within 2 years, coming off $7 and $10 respectively.
Yeah.
So, and in fact, we were down under $40 in 2008. And look where we got within a few years. So I would argue, because of some of the supply and demand issues that we'll discuss, that I see oil going to 75 by the end of this year and 90 by the end of next year. Now, I know I'm on the upside compared to most people.
I'm not seeing that either.
But you know what, Pat? I've got a lot of reasons why I feel that way, because I think when guys look at just the general economy and general GDP numbers, it's the wrong thing to look at. Oil is largely a transportation fuel today, and if we go across the board, whether it's India, China, United States, what's the strongest area for manufacturing and sales? It's auto sales, and I don't see that changing. Or not significantly. I see stronger growth in the world in auto sales, and transportation makes up about 70% of oil demand. It didn't 30 years ago. So gas has taken away a lot of oil's share in some other markets, and that's not going back.
Okay, so against that background, what do you say to the oil price potentially going to that $20? Because Saudi Arabia is controlling the spigot.
Well, right now, I'll be honest with you. I thought at the OPEC meeting something was going to be done. It was obvious that we've got a surplus of about 1.5 million barrels a day, which is only about 2% of the whole total. So, I mean, you know, you could have 1 or 2 problems in the world in some of the countries that aren't exactly the most politically stable, and the surplus is gone. Now, nobody's expecting that necessarily, and people are saying, well, the Saudis could take care of the problem tomorrow if they wanted to. Sure, they could. And what the Saudis...
So could Canada. We have almost 200 years worth of oil supply.
Yeah, we could. And, you know, and I think some production in the United States and Canada will be shut in. We've already seen some North Sea shut in. So that's another one of my theses here, Pat, is that if I look at supply, non-OPEC supply, I think, had an extremely big year last year, more than most people have anticipated. It was largely United States, Russia, on the non-OPEC side. And even some of the OPEC production was a little bit larger than we anticipated. But I've got non-OPEC growth slowing down. There'll still be, like, for example, 1.8 million barrels in growth in non-OPEC last year. I say 1 million this year, only 200,000 next year. Why? Because these lower prices will shut in some of the shale
Not
producers.
a chance.
Here's another thing that will shut in.
In the United States, they'll shut in the marginal producers, and I totally understand
that. Another area,
but
Pat.
Russia needs cash, and Russia's got to deal with China, and they're going to keep pumping like crazy.
The Russians will keep pumping. You and I are in agreement. I'm saying the Americans, Canadians, we'll see some shut-in. Here's another place where people are missing the boat on. NGLs, natural gas liquids. That's part of oil, not gas.
Yeah.
What's happening to natural gas drilling right now in North America at $3? We are slowing down, and we're slowing down in some of those liquids-rich fields. So I think other analysts should start to take a chance and look at the fact that that is not an insignificant amount of, quote, oil, because it's an oil product. And those condensates are going to slow down. So that's one of my arguments. Canada, the U.S., and the condensates will slow down, and I see demand picking up.
And I think the Saudis will keep it down there for a long time to slow down the Americans. Absolutely, I agree with you on that.
The Saudis will keep pumping, but I do think the Saudis do have some concerns about, I'm not sure they wanted to see $48 oil. Okay, I think they honestly thought it might have troughed in the 60s. But we're hearing kind of comments from our sources out of the Middle East that not everybody is that pleased with $48 oil.
No, gosh, because they got massive deficits as a result.
So I think, Pat, that my reason for bouncing back both on a supply and demand basis, as I said, the transportation sector is what you have to look at. Natural gas is more involved now. And it's another thing. People say to me, well, natural gas and oil, both going down, it's bad for oil because people are switching to natural gas. A lot of that's taken place in the world, Pat. There's not a lot of oil heating anymore. There's not a lot of oil producing electricity anymore. That doesn't exist. So I think that those kinds of days, that old 6 to 1, 8 to 1, 10 to 1 ratio of natural gas to oil is no longer relevant.
Okay, and the amazing thing is we haven't even talked about that's West Texas.
As you know, the Canadian crudes tend to be much, lower quality. So, of course, there's always been a spread. And those are, and that's one of the reasons today you'll notice. In the short run, I'm not picking a Canadian company.
Well,
in the
reason I
you
brought
noticed
it up,
that, yes.
Yes, you brought up Canadian overseas as one of your picks.
That's
okay,
right.
Why that one?
And Canadian overseas, Pat, interestingly enough, we put that on the network 8 weeks ago. It's actually up from where we put it on. It was trading at 7 cents. It's now trading at 10. So what it tells me is some of the investors have looked at this and said, this company's been beat up. Now, they've had some bad luck. I mean, Ebola has caused their major well that Exxon is drilling for them. Exxon owns 83%. Canadian overseas owns 17%. That well has been suspended because of Ebola. It's offshore, but Exxon's not going to do any work until the Ebola problems get better. Now, there's been no new cases of Ebola in Liberia in the last 2 weeks. The state of emergency has been lifted. So I would suggest this well will get worked on as we go through this year. And in some regards, if I'm right about oil prices, that's not a bad thing for overseas because all the bad news is out. Tax loss selling's done. Exxon, Pat, when I worked in the oil business with Gulf and Chevron, I always thought Exxon was the #1 company. I mean, we all wanted to emulate them. We tried to compete well with them. But they had so much talent. And what I found they were really good at was their success rate was better than ours. I'm not sure why, but it was. And when I look at their success rate offshore West Africa, that's what makes this an exciting company, is that they've had a great success rate, and this is one of their top projects. So you have to be patient, but I think this is really potentially a home run here because I got oil prices going up, and they'll be drilling this property in the next 6 months to a year. And I think the success rate here that they've got in offshore West Africa has been very high.
Okay, Mart Resources.
Now, Mart's actually a producing oil and gas company, Pat. They're in Nigeria. Now, in the days when I was in the oil business, Nigeria was somewhat problematic. There were the problems in the Delta. There were problems with the government and many of the communities. In the last decade, I think Nigeria has come a long way. It reminds me of Colombia, where a lot of the old problems have ceased to be the case. They've done a good job of working with the locals in the Delta area where much of the oil is. People are getting a better share of the revenues. They've actually gone to the big majors and say, if you're not going to develop something, let the smaller guys develop it. And the majors have said, fine. So this is what's been good for the Marts of the world. They've picked up some great properties because the majors have said, you know what, at the margin, these are not big enough for us to be involved, and we won't sit on them forever, so we'll let them go. So they've got production cash flow. The stock was $1.80 a year ago, with oil prices being where it is now. It's in the 50s. But I think it's a good leverage play. But I wanted to point out, too, Pat, that Nigeria in this area, they've just expanded pipelines. They've got a good royalty structure. They have a good infrastructure. It's a pretty good place to do work. Because what do people hear about? They hear about Boko Haram in the northern part of Nigeria, but you're not there, you're nowhere close to there. So that's what people have to understand, is that where the oil fields and the gas fields are, really there's a very good working relationship with the government and the locals, and that's what you need.
Okay. Prime Line Energy.
Pat, I've mentioned this one before on TV, and why I wanted to mention this one today is this is a gas play with a gas field in China getting $14.50 an MCF. And I get all these people phoning me up saying, well, if gas price and oil prices are going down, their prices are going down. No, they're not. People don't recognize, Pat, and you and I have talked about this before, that gas markets vary across the world. China,
they're all local.
That's exactly right. And China's trying to get more gas. Why? They want to get cleaner air. They're trying to work on that. And so they want to triple their gas sales or gas production in the next decade. And in order to do that, they want to develop offshore China, which is what they're doing. CNOOC is PrimeLine's partner. They just got $23 million. The production has started. They're going to cash flow probably 25 to 30 cents this year. So the stock has gone sideways, and some people said, well, that's good in this market. Except that I would argue that this stock is really, really mispriced, given the cash flow they're going to have, because their contracts, Pat, as I said, they're about $11 higher than what we have in North America, and so you can imagine how good the margins are. So I'm quite surprised that this company is still trading where it is, and I suppose we need a somewhat better market, but I'd like to think the markets could recognize that just the cash flow and the earnings they're going to make here, this stock's worth a lot more than 50 cents.
Great to chat, Mark. I'll watch for that $90 in 2 years. We'll see. Mark Lackey joining us, CHF Capital Markets.